Well, good afternoon, everybody. Welcome back to yet another exciting episode of the Retail Excellence webinars. Before I kick off, a few key dates for you, just to keep you on your toes, things that are happening over the next few weeks and months. The first is to say, if you haven't already applied to join us on our retail safari to London, you're too late, because that's next week. It's on the 12th of May, and the tickets are already sold out for that. The good news is that we're going to run it again because there has been high demand. So look out for us running the retail safari again, and we'll announce the dates on that probably during the course of next week, and that'll happen pretty quickly. Another event that's coming up in the not too distant future is on the 8th of June. We will be running a sustainability event in Fallon and Burn. So everything you wanted to know about retail sustainability, we'll have some guest speakers. We'll talk to you about a survey, the results of a survey we've just gone through, and we'll also give you a guide to being sustainable in retail. So watch out for that one. It's bound to be a good night there in Fallon and Burn on the 8th of June. For those of you that were looking out for us to be running a retail retreat stroke seminar this year, it's back on. It was going to be in City West. That's now not happening. It's going to be in Carton House near Maynooth. And that's going to be on the 6th and 7th of September. So again, more news on that and the launch of that very soon. And if you haven't already seen it, you'll see that we've launched our Retail Excellence Awards. That was launched last week. And obviously entries are now open for that. And that award dinner will take place in Galway on the 12th of November. So those are some of the key dates for your diaries. And watch out for our member update, because they'll all be repeated in that over the next week or so. So what's today about? Well, if it feels like we're in this transition period, doesn't it? A lot of you that I've been talking to recently are saying that business has been pretty reasonable during Q1, certainly plenty of people out there, some money being spent, but lots of uncertainty about the future. And then from a cost point of view and a people point of view, those supports that have been in place and keeping us afloat for the last 2 years have now come to an end. So really today is about, so what next? What next for retail from a people point of view and from a financial point of view and a cost point of view? So I'm delighted that on the panel today, we've got talks from Claire Davey, Tax Director with KPMG. I'll introduce Claire in a second, and the irrepressible Tommy Smyth, who is going to come in and talk around some of the things that are happening from an HR perspective over the next few weeks. But Claire, you are very welcome. Any questions that anybody's got from Claire, please stick them in the chat box, stick them in the Q&A at the bottom, and we'll have some time at the end of today just to go through and ask those questions. Claire, over to you.
Great, thank you for the introduction, Duncan. So good afternoon, everyone. For those of you who don't know me, my name is Claire Davey. I'm a tax director in KPMG and specialise in the area of employment tax, global mobility and reward. And today I'm really delighted to be here with you in association with Retail Excellence Ireland to, as Duncan said, bring you up to date on the latest developments and importantly, where things are headed in the area in a post-COVID environment. I'm joined today by my colleague, Dara Duffy, an Associate Director in our People Services Tax Practice. And Dara's on standby today throughout the presentation to answer any questions you might have. So please feel free, as Duncan said, to drop your questions into the Q&A function at the bottom of your screen, and we'll do our best to pick them up during and after the presentation. So all updates today are particularly pertinent at this time, as Duncan mentioned. So we do hope you'll be able to gain a couple of nuggets that will help you in your business. So without further delay, we might kick off. So firstly, I'm going to look at some recent revenue updates on the COVID business support schemes, specifically the Employment Wage Subsidy Scheme, or EWSS for short, and the Debt Warehousing Scheme. And these would be of particular relevance to retailers who've availed of the schemes or are continuing to avail of the Debt Warehousing Scheme. So in relation to the EWSS, I'm sure you'll agree this has really been a lifeline to many businesses, badly hit by the pandemic and instrumental in retaining employees. So what is the current status of the scheme and what do retailers really need to be aware of as they emerge from the scheme? Well, as many of you will be aware, for the majority of Irish retailers, EWSS ceased operation at the end of April. There is a further general month's extension to the scheme to the end of May, but this is for businesses directly impacted by the public health restrictions in place in January and December. So namely the hospitality and entertainment sector. So for most, 30th of April, I'm sure marked a return to normality for many payroll operators around the country. So from a procedural perspective, given a further general extension to the scheme is unlikely, there are some key actions retailers will need to consider if you haven't already. So for example, number one, deregistering from the scheme via ROS in the managed tax registration section under the EWSS option. And number two, removing the EWSS marker from your payroll software from any future payroll submissions. So next, just really in terms of revenue compliance activity in the area, this is currently ongoing, and I'm sure many of you will have already undergone some level of compliance check, either a revenue aspect query or an assurance check. And we do expect these checks to continue after the scheme is ended. So it is worth noting, unlike the TWSS, Revenue are taking a somewhat multifaceted approach to their compliance checks on the EWSS, which is really not dissimilar to what we'd see in practice more generally in relation to PAYE compliance interventions. So for example, in addition to the real-time checks conducted on payroll submissions during the scheme was in operation, Revenue are also carrying out more in-depth compliance interventions under the code of practice. And similar to TWSS, they are in practice raising assessments where agreement isn't reached. So in light of this, it will be important for retailers to have that comprehensive and robust file in place to support your eligibility under the scheme. From experience to date in assisting employers in relation to compliance checks, particularly where participation is under review, having a well-documented positions paper, which clearly sets out, for example, your supporting analysis, key underlying assumptions underpinning your projections, and any detail around how you reasonably expected to meet the 30% decline based on the operating conditions in play at the time, will be key to helping you frame your response to Revenue and close out in those compliance checks. Interestingly, Revenue recently published some statistics on the subsidy repayments from employers, and they've confirmed that to date, they've collected over 100 billion from revenue compliance checks, interventions, and voluntary repayments. They've also initiated over 6,000 EWSS compliance interventions, and more, as I said, interventions are expected throughout the year. But on the more positive side, they've also confirmed their experience to date arising from these interventions is that the vast amount of businesses have operated the scheme in good faith and in accordance with the underpinning legislation. But a word of caution here, Revenue did publish an article in the Irish Tax Review last September, and it's certainly worth a read, which has confirmed they have identified several employer data quality issues arising from their analysis conducted on the EWSS and TWSS claims. And they do expect to have a renewed focus on data compliance interventions as the economy recovers. So really with that in mind, aside from the usual off-payroll matters you'd be familiar with as part of maybe a PAYE health check or self-review, it is important to identify and rectify any data quality issues that may have arisen within your organisation over time, as this will help to ensure a high degree of compliance with the real-time reporting regulations going forward. And finally, just one practical point in relation to the EWSS compliance checks. Some do involve a 5-day turnaround time to respond to Revenue. So it will be important to keep an eye on that ROS inbox for retailers who are experiencing genuine difficulties in meeting that short deadline. I would encourage you to reach out to Revenue immediately and request an extension. And in practice, we are seeing Revenue being accommodating to such requests. So moving on now to the debt warehousing scheme. And just by way of recap, as many of you will be aware, the debt warehousing scheme was introduced at the early stages of the pandemic and provided much needed cash flow to many retail businesses. But in summary, this allowed businesses to park certain unpaid tax debts, including PAYE and VAT, for a period of 12 months after resumption of trade. So today I'd like to highlight a couple of key points in relation to the continued availability of the debt warehousing scheme. And this will be of particular importance to retailers still availing of the favourable terms under the scheme. So in summary, following a recent revenue update, Revenue have now confirmed they'll be shortly contacting business still availing of the scheme to remind them that their debt warehousing remains unpaid on an interest-free basis, and also that businesses can at any time prior to the end date make repayments to Revenue in respect to these debts. They'll also be reminding businesses of their ongoing conditions that need to be satisfied to continue to avail of the scheme, particularly the obligation to file all current tax returns as they fall due. So it will be important for retailers, to be aware that failure to meet these conditions will essentially mean you'll no longer be able to participate in the scheme and payments will fall due with immediate effect. Helpfully, there was a short window of opportunity up to the 30th of April to bring your filing position up to date. But given this deadline has now passed, I would encourage retailers who continue to have outstanding tax returns to bring your filing position up to date as soon as possible. And if you continue to experience difficulties in meeting your filing and payment obligations, I advise you to contact Revenue immediately. And we do expect you should be able to agree a solution with them. For example, if that's a phased-based arrangement over an agreed period of time, but the net point here is that communication with Revenue is key in such circumstances. And lastly, just based on our experience to date, Revenue do seem to be taking a practical and pragmatic approach here when engaging with businesses regarding their eligibility for the debt warehousing scheme. Now, that said, should Revenue make inquiries into your use of the scheme in the future, I would recommend, similar to EWSS, having a supporting file at hand to validate your inability to pay, including, for example, supporting documentation and key underlying assumptions made. This will be very critical and important should they have any queries in the future. So moving on now, just to touch on recent Revenue updates on the temporary COVID concessions. And these were introduced at the early stages of the crisis, which continue to remain in force during the COVID restricted period. So until recently, it wasn't entirely clear when these COVID concessions would be withdrawn. However, following recent Revenue updates, we have got much needed clarity now in relation to these concessions. So retailers who've been availing of the concessions, it will be important to be aware of the updates so that you're not relying on COVID concessions which are no longer available in practice. So starting with the good news, the small benefits exemption, which I'm sure many of you will be aware of, the PAYE rules have traditionally allowed employers to provide one tax-free voucher or incentive of up to €500 per year per employee. And this is commonly referred to the small benefits exemption. Now, during 2020 and 2021, for frontline workers or other key staff whom employer wished to reward for their exceptional efforts during the COVID restricted period, Revenue helpfully waived the usual requirement that only one tax-free voucher could be issued, provided the cumulative value of the two vouchers didn't exceed that €500 limit. So for this cohort of employees, employers could either choose to accelerate part of an incentive, usually paid later in the year, or make an additional award to these employees at any stage during the year. And the good news is Revenue recently confirmed that this concessionary treatment will apply for the 2020 tax year also. Now, what a business views as a key staff will vary, of course, from business to business, and Revenue guidance in this area is quite light. So I would caution businesses to automatically assuming that the additional tax-free voucher will apply to all staff. But if you are availing of this concessionary treatment, my advice is to retain all appropriate documentation pertaining to your application of the concession, should Revenue decide to review this in further detail at a later stage. So next, just to confirm that some further good news in relation to expenses incurred by employers on behalf of employees. For example, COVID testing and flu vaccines. Helpfully, Revenue have now confirmed that similar to the 2000 and 2001 tax years, no BIK will arise in respect to these expenses also for the 2022 tax year. And any subsequent years then will be reviewed on an annual basis thereafter. In relation to travel costs incurred by employees while travelling to and from their normal place of work, under normal circumstances where an employer covers such costs on an employee's behalf, these would be considered taxable expense. However, helpfully in response to the pandemic, Revenue did confirm that employers covered the cost of taxi journeys to support employees travelling to and from work due to health and safety concerns. No BIK charge would arise. Now, helpfully, Revenue recently confirmed that this concessionary treatment will continue to apply to the end of June, and the go-forward position will then be confirmed by Revenue thereafter. Next, just in relation to employer-provided vehicles, as many of you will be aware, Revenue introduced some helpful concessions with regard to the operation of benefit in kind and company cars. So, for example, for employees who would typically undertake business mileage during the course of their employment duties, given their business mileage was significantly curtailed during the COVID restricted period, employers were permitted to calculate their BIK charge in 2020 and 2021 based on the pre-pandemic month of January 2021, and this being more reflective of their usual business mileage. And Revenue's recent update now confirms that this COVID temporary concession will only continue to apply into 2021, where public health restrictions are in place, requiring employees to work from home. Now, obviously, this is not the case currently, so the expectation from January 2022, when restrictions were lifted, is that employers would calculate the BIK charge once again on the employee's actual business mileage incurred during the period in question. So moving on to the next slide, just to touch on remote working in a domestic context. And I suppose given the steep rise in remote working over the last 2 years, a trend which is certainly set to continue, whether that's a mixture of office and home working. As many of you will be aware, in 2021, Revenue introduced some helpful reliefs to compensate employees for the additional costs incurred while working from home. And while the government is currently looking at introducing legislation which would provide greater rights to employees while working from home, I can now confirm from a tax perspective, these reliefs introduced in 2022 continue to remain in place. Although we do expect Revenue to revisit these current tax reliefs at some point in the near future, really to reflect the ongoing reality of these current new working relationships or arrangements. But by way of recap, as things stand, Revenue permit employers to make a tax-free payment of up to €3.20 per day worked from home per employee, provided there's a formal agreement in place requiring essential duties to be performed for a substantial period. Now, this can, of course, be costly for employers, not only due to the number of days, but also if you have a large number of employees who have a working from home arrangement. Now, alternatively, employees can claim a pre-tax deduction on their tax return, similar to a pension deduction, for 10% of the utility costs, including broadband, incurred during the home working period. And this is obviously less generous in terms of value to the employee, as it will depend on their marginal rate of tax. However, if you do decide to pay a flat rate payment to employees, it is advisable to document this as a per diem, as opposed to an annual home working allowance, given that an allowance, similar to all allowances, will be taxable as normal through the PAYE system. And lastly, where employers provide employees with the necessary equipment to enable them to work from home, helpfully, this doesn't give rise to a taxable benefit, provided the equipment is primarily used for work purposes and any private use is incidental. But it will be important to note that employers should purchase the equipment directly, as opposed to the employee incurring the cost and then seeking reimbursement from their employer, which would give rise to a taxable benefit. So lastly, just moving on really to touch on a couple of key developments. And I suppose as a general comment, we are seeing a renewed focus on employment taxes more generally in recent times. And given the government will undoubtedly be faced with budget deficits as a result of the pandemic, we do expect this heightened kind of revenue focus to continue in the form of PAYE audits and interventions going forward. So with this in mind, I just wanted to bring to your attention today 2 key developments of particular relevance in a post-COVID environment. So firstly, it's important to be aware that Revenue recently introduced a new code of practice for dealing with compliance interventions, which came into effect on 1 May and will apply to all revenue interventions notified from that date. The changes contained in the new code of practice represents the biggest overhaul to Revenue's long-standing approach to revenue interventions, and so it will be important for retailers to be aware of the changes, particularly around the disclosure opportunities. So in the interest of time today, I'm not going to go through the changes in any great detail, but broadly, the new compliance framework is moving to a graduated system comprising of 3 intervention levels. So level 1 interventions being in place to support compliance, whereas level 2 and level 3 interventions being in place to confront non-compliance. Under the level 1 interventions, what we're likely to see now is Revenue routinely asking employers to carry out their own self-review of PAYE and other tax matters. But helpfully, employers will retain the ability to make an unprompted qualifying disclosure under this level. Whereas under level 2 interventions, which covers risk reviews and revenue audits, there's no ability to make an unprompted qualifying disclosure at this level, so naturally higher penalties would apply here. And lastly, level 3 interventions, these will deal with revenue investigations where serious tax or duty evasion was deemed to have arisen, and so there's no ability to make a qualifying disclosure at this level. The second key development I just wanted to flag today is in relation to the modernisation of the PAYE system. And this really is a highly topical area at present and a key area of revenue focus. I mentioned earlier data quality interventions. So it is worth being aware. We've certainly seen a difference in Revenue's approach to non-compliance with real-time reporting requirements over the past few years. In 2019, much of the focus was on the successful implementation of the new scheme. And Revenue were quite lenient as a result, but we are seeing a lot of evidence to suggest a harder line approach is now being taken by Revenue, and they fully expect employers to have grasped the new rules and be compliant. So with this in mind and the new code of practice being rolled out, what key actions might you consider at this time? So number 1, look to undertake a self-review of your PAYE and real-time reporting administration to date. It's always good practice to do a routine health check on your PAYE tax processes and review that. To consider any improvements necessary to comply with the PAYE and real-time reporting regulations going forward. And what we often see in practice is even minor tweaks or amendments to existing policies and procedures can be highly effective in helping employers meet those PAYE obligations and hence avoiding costly PAYE settlements. And finally, then look to address any identified gaps or exposures, or whether that's correcting historical issues by way of disclosure, as mentioned earlier, or tightening up on existing processes or procedures, or establishing new ones. All of these can help to mitigate compliance risk in the PAYE area and quite possibly a revenue intervention. So with that, I hope you found the updates useful, and no doubt there'll be more changes as things emerge over the coming weeks and months, and I'll be sure to keep you updated. But for now, I'm going to pass you over to Tommy, and I'm happy to answer any questions you might have later in the webinar. Thank you.
Thanks, Claire. Good afternoon, everybody. Let me just share my screen there now and get my slides up and running. Right, hello again, everybody. I think, as always, in contributing to these webinars, it's maybe, you know, a little update on the usual eclectic mix of all things employment law and HR that can affect you guys. So today's menu is, again, a little update on a chestnut that's been hanging around a little while now, that is statutory sick pay, and just so that you guys are very clear maybe on where we're at and both in terms of when it may be coming in and what the latest on what's coming in and how we may manage and what problems are. We have a bit more clarity then on pensions. Again, it is an old chestnut. It's been rumored for a long time, you know, back to the mid-noughties, that the state pension model isn't really going to be fit for purpose long term, so we have to make changes. So we definitely have more detail. There's a lot more to come, but we have good headlines now that we can inform you of. I want to bring you up to date maybe on just, I was saying earlier, the weather's good, so the WRC inspectors are back out on the road again, earning their expenses. So just maybe early summer trends we're kind of seeing as to what maybe some hot topics for them over the summer season, and then just a couple of legislative updates that again are coming in the next while regarding new increased levels of parents' leave, and the first round of gender pay gap reporting for the biggies on the call, those with 250 or more employees. Okay, so statutory sick pay. We still have no formal start date, okay? The latest is that it's been approved by your relevant committee in the Oireachtas, and I think it's going back now for voting in both houses. I think overall the government's communication on it hasn't been great. I do get the fact that they committed to introducing sick pay, pandemic, in the middle of a pandemic, and initially it was mooted to come in at the start of 2020, and then I think in the middle of when the Omicron wave really was gathering momentum, it kind of really said, well, do the government really want to bring in sick pay when a huge cohort of the country would end up looking for sick pay possibly on the 1st, 2nd, 3rd of January. So they shied away from it, but there was very poor communication around that. It's still there. It comes up in the news every now and then. So not much has changed to the current model that's being introduced. So from the day this commences, for the first time in the history of the state, it will be the law that employers must pay sick pay to qualifying employees. So 13 weeks is the length of service. Once someone's there that length of time, they qualify for initially 3 days of sick pay. So there may be that if this is launched later in the year, it may be pro rata. So for example, if it's the 1st of September, your 3 days may be 1 day for the remaining third of 2022, 3 days in 2023, 4 days in 5 days, 2024, 7 days in 25, and then up to 10 days in 2026. Again, it seems a pretty consistent message that it's going to be paid at 70% of the person's wages, capped at a maximum of 110 for people whose wages are quite high maybe, and where 70% would be above that. But again, at the moment, it states that a medical cert is needed for each case of SSP being paid. So that then leads on to some of the questions which, have you guys have made me aware of. I've been thinking about Duncan and the lads in REI know from us, and governments know from them. So like these are pretty publicly questions that are being asked pretty publicly. We have, and the first question here, which I know it's me not giving you information, but it's me maybe making you aware of the issues that could arise and that we're on here, okay? If I understand if an employee's on a modest enough wage, say €500 a week, and if they are out sick for a day, 70% of their day's sick pay is €70. So for them at the moment, for them to claim that €70, they have to get out of their sick pay, walk down the road, go into their doctor's surgery while sick, and pay for a medical certificate, which may be the 70 quid or the 60 quid or that they can earn. In some ways, to do that, it may mean they're at a loss for that date to claim the day's sick pay. It makes no sense. So we need to get further clarity on if that's the fact. Or one of the solutions I'm worried about is there may be the version of a diet medical cert may come in, that there may be a phone call to a GP who gives some sort of a specific type of script to the employee which qualifies for statutory sick pay. But look, this is a question, we're on it, government, no employers' concerns about it, and we'll update you when we get any more information. I think another one that's really important, especially for those of you who've been proactive on this and already have a sick pay scheme in place, is, the message at the moment is, it's a pretty Irish message, from government. It seems to be is, sure, whichever scheme benefits the employer greater, shall roll with that one. So if you have an existing occupational scheme versus the SSP, and okay, understood in principle, but there are some kind of further questions that arises in that most occupational schemes that employers will have, and this even stems back from the days of JLCs, where grocery and catering, many of the attendees of the webinar will have been subjected to JLCs back in those days, and they would have had sick pay schemes. But there was always the concept of waiting days. So there was always the concept of pay never arose for day 1 or day 2 of an absence, it then would have kicked in for maybe longer term ones to look after employees. So the problem with SSP paying from day 1 is, which is more beneficial to an employee, and it will change at any given year. For example, if I hurt my ankle badly and I'm out for 3 weeks, well, then SSP will run out after 3 days. So an occupational scheme is better for me. However, if I miss the same 15 days of work, but in 1 and 2 day slots over the course of a year, well, clearly SSP is going to be better for me because I would qualify for that immediately, whereas I would never meet the waiting threshold for an occupational scheme. So I hope you're still with me. But again, these are questions that need to be clarified for people, or else there'll be a lot of mess when the legislation is finally enacted and introduced. But again, the message really is it's still not in. We will update you in advance of it coming in, and Retail Excellence and ourselves are on the case for any of the predicted problems we may see in the enactment of it once it happens. So auto enrollment pension. So look, again, I've been, it's something I've raised in conversation with people at appropriate times, kind of over the years. It's more bad news in terms of added costs, burden on employers. But look, I suppose there's a moral reason for it, and again, by way of introduction to it, I mean, it's long that I can remember my father mentioning Seamus Brennan, if you remember, the now deceased kind of Fianna Fáil minister back in the day, was mentioned the likes of this, that some form of employer pensions are eventually going to have to come in. And it really stems from a scenario where, the current state pension, old age pension, it's just not sustainable. Okay. I think, and really, to be black and white about it, it's because we're too healthy now, and we're living longer than we would have before. So previously, if you qualified for the state pension at 65, perhaps informally there was this budget that you might get it for 10 years before passing away. Whereas now, Irish people don't have the same physically demanding labor style jobs that maybe generations previously had, improvements in medicine and all that. We're living longer. So someone lives until 90, they have 25 years possibly claiming the state pension every week. So that, coupled with, if you look at more people are in that older bracket or are living longer, the number of workers supporting each pensionee is the ratio is going down. So it used to be 8 workers would support the pension of 1 retired person. That's going to be as low as 3 to 1 and 2 to 1 in coming years. So something had to give. Okay. And that was long mooted that it would. So we now have more details that from January 2024, employers are going to be contributing into a pension pot for employees. It starts with a 1.5% contribution, and then over time, over the next kind of 9-10 years up to 2033, it will increment up to 6% contribution. That's just a little chart there showing kind of that this is basically a pot where the employee themselves, the employer, and the state all now contribute in a pay-as-you-go style pot, so that when a person reaches a retirement age, they have enough to have a reasonable level of comfort in their retired years. Okay, so some points to note, and again, I stress, guys, this is what we know so far. You can really expect, as I say in the next slide, there'll be a lot of column inches on this, especially as next year gathers pace and we're staring down the barrel of this more. Okay, but at the moment, what we know is that qualifying employees are between the ages of 23 and 60. Okay, and they must be earning a minimum of 20,000 euros per annum, and that the contribution will be limited to the first 80,000 of earnings. So if you have high earners, it may not be your 1.5% incrementing up to your 3 and 4.5 of their total earnings. It's up to the first 80,000. So we're going to have a new Quango, a new agency created. The Central Processing Authority is going to be created and launched to kind of manage this monster of a system, I suppose, if you think about it. All right. Private pension firms will, of course, be involved to manage portfolios. They'll be called registered providers, or RPs. And, look, at the moment, the information we have is that, employees will have 4 risk portfolios, as anybody who has investments would understand that, when you reach a certain age, you want it to be kind of safe and kept nearly in cash. And maybe if you're younger and wilder, you'll be happy to put it all on black, kind of, in some casino somewhere, that style of portfolio. All right. And look, the model of this is quite simple, guys. It's like we all have a pension cable trailing out of ourselves. And as we start employment with somebody, we plug it into that employer. And then whenever we move employment, I leave one retailer, I go to start with another retailer, I simply unplug that pot, I bring it with me, and when I start my new job, I plug in to their pension scheme, and I keep going as seamlessly as that. All right. So look, I think, you know, the reason for kind of raising it with you now, okay, well, employees can also opt in for a sabbatical, opt out of the scheme, or opt for a sabbatical on the scheme and take a break from it, okay? Like I said, expect a lot more information on that, especially as next year gathers pace. Reason for saying it now is obviously a lot of you guys are thinking about how to attract staff, how to keep staff, retention issues, terms and conditions and perks. And a lot of you may also be doing pay deals on your own or through the likes of trade unions, the likes of that, which it's not a stretch to say some of those pay deals may actually drift into 2024 if you're kind of doing something like a 2-year deal. So just be aware now of, you know, 23 to 60, the demographic of your employees over 20 grand, you know, there's going to be a levy on their employment and an increased burden, okay, on their employment. So I'm seeing some clients doing wage deals, and they're actually either allowing in the wage deal for that 1.5% from January 2024, or they're actually creating a pension now to actually get ahead of this. And I suppose to capture both the positive moral view on looking after their employees and creating a pension ahead of when they're forced to, but also, you know, you're giving an increase in costs now, which possibly negates a second hit then once January 2024 comes around. Okay, so they're just some points to note on that one. So yeah, look, the WRC inspections are back out. Thankfully, you know, they're really focusing back on their core employment law inspections now. And remember, during the COVID days, the WRC inspectors would also be inspecting your return to work protocols or your work safety protocols as they became then. They're back to focusing on the same kind of core employment law deliverables on employers. Okay. There's a big focus on work permits at the moment. I get the frustration that people in retail and hospitality, maybe in sectors like that, will feel about the delay and the backlog of work permits. It doesn't stop the inspectors kind of, you know, and that's one government body, of course, but it doesn't stop another government body and their inspectors still hitting employers hard on examining records and examining active work permits for people who, you know, they may kind of just turn up and want to talk to your employees, or maybe the usual letter in advance, I'm coming in 3 weeks' time. But work permits is definitely something they're examining, just to make sure that, you know, in the teeth of a staff shortage, in the teeth maybe of there being delays on permits, that employers that aren't perhaps crossing that line and being cheeky and employing people who don't have a proper right to work. Another major one, which it was during COVID and it still is annual leave. All right. 2020 and 2021 weren't normal annual leave years in terms of obviously what employees worked, and any employees on layoff clearly had a lot of downtime, and obviously the availability of foreign travel and such likes. Okay, so there were a lot of factors that made them atypical years for annual leave. And I suppose employers who may never have really carried over holidays before were put in a position where they did. And look, it's just the case now that we're kicking on. Thankfully, we're moving on, and really holiday balances should be starting to equal out, because, you know, you have logical reasons for that in terms of excessive balances causing difficulties for your roster. And you also have technical legal issues in that, you know, an employer's annual leave year may be January to December, and you can only carry over for 6 months technically. But then you have the in-law leave year, the Working Time Act, which is the 1st of April to the 31st of March. And the fact that, you know, that you know, it's really the end of September of this year when you're 6 months at the end of the 2021-22 year. So look, it's just really the lesson in this is have a look at annual leave. If anybody has an abnormally high balance for annual leave, try to sit with them and plan a workout for that they can kind of get back to a reasonable level, map out the rest of the year. And then as you guys would cross maybe from 21 into 22, hopefully you've washed through any of the mess or residue left by some unusual annual leave years in 2020 and 2021. But be proactive on it, because I'm telling you, the WRC will not be impressed if they inspect you over the summer and there's lots of hangovers of 2021 holidays and people haven't really taken many breaks in 1-2 years. Okay, and look, of course, as one of my sayings is, right, that the key pillars of information for any WRC inspection is your contract, your working time record, which has to be either an electronic record from the input of the employee where they fingerprint or they clock in or something like that. Okay, like a roster taken down off the wall isn't acceptable. A signed roster is, okay, but a roster isn't. So your contract of employment, your working time records, and your pay slips. All right. And the main thing is they all have to sing to each other, lads. Okay, because what an inspector will do is they will pick an employee and they will pick a week. So they will say Tommy Smith, second week of February. They will say Duncan Graham, October 2021 bank holiday week. Right, I want to see Duncan's contract, I want to see his working hours records, and I want to see his pay slip. And what they will want to see in the contract is Duncan Graham, €13 an hour, okay, 25 hours a week. They'll then want to see the working time record, which makes sense, which again shows circa 25 hours a week. They'll then want to see the pay slip, which again shows your $12.50, you're multiplied by 25. They'll want to see if there's any reference to Sunday premium in the contract, or if there's a separate Sunday premium on the pay slip. They'll want to check, they'll be checking randomly for a time when a part-timer took holidays. They'll be checking randomly for a time when there was public holiday, and how you paid part-timers and how you paid full-timers. So they're the 3 records to have, and to just make sure that there's a nice hum from one into the other and they all make sense to each other. Okay. So again, look, to close out with 2 further ones, all right. First one's quite a simple one, all right. So you got confused with all the P's. So not to be confused with paternity leave or parental leave. We have parents' leave, is now moving from 7 weeks, is moving to 7 weeks from 5 weeks from the 1st of July. Parents' leave is employee can claim state benefit when they're off on it for a child who's under 2. So they now have an extra 2 weeks to play with on that, and they have to give you 6 weeks notice of an intention to take it. And then just in case, guys, you have in your handbooks, you have all these leaves specifically set out. Don't forget to update a handbook, because that's one thing we often see when we get handbooks, that if you specify too much information and all these plethora of leaves that's there, some things ends up going out of date nearly every year at this stage, right? And then finally, for organizations that have more than 250 employees, all right, you're up first when it comes to preparing a gender pay gap report this year. Okay. Now, what we know so far is that you'll pick a time in June where you take a snapshot of the terms and conditions of your employees, and then you have until December to prepare your report. We are waiting, as always. Government have produced legislation, and they've now given this information about the June and December deadlines, but we're still waiting on regulations which will give far more active, logical information to employers on how to go about preparing the report. But what we do know is that you're going to have to give the mean and median gap between male and female workers in terms of their hourly rate. You're going to have to break down people's remuneration into an hourly rate, okay, and compare male and females and give that gap. All right. You're going to have to then give also the mean and median gap in terms of any bonus payments. You're going to have to give the percentage of men and women who receive a bonus and the percentage of men and women who receive benefit in kind. All right. And you're going to have to give a comparison between full-time and part-time as well. We know those headlines. How exactly you go about it, we're still waiting on final regulations from government to give that advice, okay? But remember, look, the gender pay gap report is also going to have to identify what the pay gap is in an organization. It's going to have to be clear as to why does the organization feel it exists, and what is the organization doing to close it? Because the gender pay gap, it's nothing to do with equal pay for equal work. It's to do with the distribution of genders, all right, throughout an organization. So if obviously you have an organization where it may be 50-50 male and female in the trenches at general operative level, but if at senior level it's all men, well then when you average out the hourly rate between men and women, there's going to be a gap. Actually, men are going to be higher. So it's going to have to be highlighting that in an organization, and an employer is going to be under pressure to explain why it's there and what they're doing to close it. And your gender repair report is going to have to be public as well. It's probably going to be on your website and such like, so people are going to be able to download it and review it. And so for you smaller operators out there who are laughing at the big lads now, your time is going to come. So we're all going to watch the big lads do it, and then it ends down towards those with 150 employees, and then down to those with more than 50 employees ultimately. So you're not escaping. It's just a stay of execution for now. So okay, so we get to see how the others construct it, and then hopefully copy them down the line. All right. So full of good news as always is what I am. So I don't know, I haven't been keeping tabs on the questions as I've been going in. I know Duncan or Keelan, if you maybe want to pop in and tell me if there's any questions there, and I'll stop sharing.
Tommy, there's nothing just at the moment. I'm sure there might be bits that come up.
That's good, Claire, isn't it?
Yeah, but I might throw a few in for you. But before I do that, one of the things I forgot to mention when we started out today was the announcement this morning that there is another round of the online retail scheme. For those who are interested, has been launched this morning, obviously designed to get retailers trading online. The total size of the fund for this one is 9.3 million, which I think is significantly higher than previously. Memory serves right, they were around 5 million before, so that's significantly higher than the previous ones. I guess that's the good news. You've got to move quickly because it's only open until the 1st of June. And yet again, you've got to have 10 or more full-time employees in order to get this. I know that's been a cause of concern for a number of businesses, a number of retail businesses that fall into that SME bracket. Many of you on the call don't fall into that 10 employee bracket. And I know that the government are acutely aware of it because we've been banging this drum for a good many months now. And I know there's work going on in the background, but I was hoping there would be something today around that less than 10 employees, but clearly not. But I do think it is coming, or at least some variation of a scheme that is open to smaller businesses will come through. Anyway, less of that and more back to this. So if there are any chats, please just drop them in. Claire, can I just come to you first, right? Just and thank you first off for everything that you've just said there, because I think there's some really good stuff there, albeit both of you talking around, cost. That's all I can hear is cost coming to business at the minute. But if you were to look at some of of what you're seeing, sort of the traps that businesses are falling into, particularly with revenue just at the moment, is there one thing that you'd say, guys, this is the big thing that, this is the big trap that businesses are falling into, this big thing that revenue are looking for, watch this. Is there one thing, or is it, multiple number of things that you need to be aware of?
Yeah, I suppose it's a couple of things, Duncan. I mentioned earlier on kind of the processes and procedures around PAYE to ensure compliance, right? And so we obviously, the real-time reporting system was introduced in 2019 to make the process for employers more efficient. But I suppose the flip side of that is that you're now kind of providing much more information to revenue, right, in real time, and they're able to review payroll submissions and information that employers provide in real time. So they really are getting a real insight in real time into that data, that employer data. So I suppose arising from that are, a lot of aspect queries and a lot of questions from employers. So it is certainly igniting more questions from revenue to employers with regard to their data. So I think there's definitely, as mentioned, going to be a huge focus on data quality interventions, because they have all, they have all this data now. They've, given employers time to get to grips with the new system. And now they're kind of, asking questions. They're using the data to have more focused PAYE interventions. And I suppose the big thing I would say to employers now is really get ahead of that, get ahead of those questions, because you don't want to be on the back foot. We are seeing data quality interventions, questions around that as part of compliance interventions. So usually they would have focused on the usual kind of, I suppose, old chestnuts around off-payroll matters, contractors, professional subscriptions, genuine business expenses, looking at kind of your accounts payable and going through all your payroll data to ensure you're compliant around those payroll off-payroll items. But now what we're seeing is they're looking, I suppose, at your processes and procedures to ensure compliance. So with real-time reporting, it's all about timeliness and accuracy of getting the information from your, your expenses payable if that's if they're not through the payroll, and there's private expenses that need to be fed through to payroll to be taxed, or you know, items that clearly need to be communicated in real time so that the PAYE is captured. So I think really having those robust kind of controls in place so that you have HR, you have finance, you have tax, everyone is aligned and the information is flowing, you know, in real time to enable employers to meet their information return in real time on or before that payment date is critical. So certainly I think we're going to see a lot more as we move through the next coming months as well, and in the post-COVID environment, a real focus around that. I did mention, Duncan, earlier that there was a really helpful article published by Revenue back in September. I'll share it with you, and you can certainly share it with everyone on the call. But you know, they've highlighted kind of a lot of data quality issues that they're seeing in practice, and even, you know, how to rectify those issues. So I would advise to have a look at that, to then, you know, go back to your business and have those conversations. You know, do we have those robust controls in place to make sure that the information is being captured in real time, especially around taxable items that need to be communicated to payroll to meet kind of real-time reporting kind of obligations. So certainly that's the big thing we're seeing, Duncan, questions around that. And
Claire, are you finding Revenue to be pragmatic in terms of their approach to all of this? Because obviously it's a massive transition that we've all gone through. We've all kind of got used to the EWSS being there during the pandemic, and we got used to the supports that are in place. We're now coming out. You know, businesses are going to be querying. I'm sure you'll get calls yourself. But are you finding Revenue to be helpful, I guess, is the message? Yeah,
certainly in relation to EWSS and operationally and the compliance checks on that, we are seeing that they're taking a kind of fair and pragmatic approach on that. If you're able to really demonstrate your rationale for remaining in the scheme, that you've met the 30% test, that you're, you know, you have all those, I suppose, all those tests with regard to the COVID income support schemes, certainly they are taking a pragmatic approach. But we are seeing, I suppose, there was probably a stay on revenue audits during the COVID period, which was good. We saw a lot more revenue aspect queries as opposed to audits. But as we move through 2022, I would say that we are seeing a lot more revenue audit activity. Certainly, I do think, unfortunately, that's set to continue into the coming months. So I think it's harder, probably, and it's going to be harder to kind of negotiate with revenue on certain areas. So in the past, we might have had you know, kind of approaches and positions, and revenue were more practical. But I think certainly moving forward, and based on our experience to date with employers, they aren't as pragmatic when it comes to revenue compliance interventions and aspect queries, and they're asking a lot more questions. And I guess that's certainly from the data that they're getting. It really gives them an insight. So I think my advice would be get ahead of that, you know, do your own self-review. The new code of practice is certainly emphasizing and trying to encourage employers to do that PAYE self-review in advance, so that you're kind of getting ahead of it, have your documentation to support your, you know, your tax analysis and your data as well, and make sure that's in place. But certainly there is a kind of renewed focus, Duncan, on compliance interventions and that, and unfortunately some areas are not being as pragmatic as we'd like.
Yeah, okay, which I guess is where your support comes in, to pick up the phone or drop an email into you guys and to get some of that support. Yeah. Great stuff. And Tommy, you had me scrabbling around there wondering what I was doing in October 2021. I was a bit worried there for a minute when you were talking, but anyway, I think there was a question there for Claire, which we'll just share. I know you've answered it, but maybe it's worth just opening it up. So great session so far. First bit, well done, Tommy. That's unusual for you, but anyway, well done. Question, Tommy, SSP. How are entitlements calculations for part-timers managed, particularly if a part-timer has a second job with an alternative employer? I know you've answered it to Claire, but maybe you.
Yeah, look, the short answer is like, I don't know. This is why we're asking questions of government on this and spotting gaps. And unfortunately, look, like, okay, I'm not gonna. It's not like I think the government are doing a particularly poor enough job on this. I do understand though, like they committed to bringing it in, and then there's the middle of a pandemic, and employers are in big trouble and don't want it. So you know they're trying to keep it bouncing along as best they can, but probably delay it as well to get employers into a better time when it's going to be launched. Okay, there's a lot of gaps. Look, the three questions I gave was probably just a sample of the issues. Okay, on this, I'm pretty sure that Claire and most other listeners can think up of but a what if this and a what if that scenario. Okay. You know, because like Murphy's Law will dictate as well, like, you know, the employee may have been off, or the employee who will work an 8-hour shift and a 6-hour shift, but they'll ring in sick for their 3-hour shift. Okay, so what's the day's pay they get then paid for that? Or like Claire has said, they're going to do a 5-hour shift for me, but then they're going to go and do pull pints in the pub that night. So are they missing both shifts then, and who pays them what in terms of statutory sick pay? You know, I don't have an answer for that. What I would suggest though is, like in any final review of this or in any guide notes that would come with this, there'll be some sort of a formula, as there maybe is for the likes of, you know, redundancies for the likes of public holidays and such likes, you know, when you use definitions in public holidays like a normal day's pay or a normal week's pay, you're given some guidance as to the algorithm to use to actually work out what that is for a person, especially in the likes of retail and hospitality, when there can be, you know, heavy weeks, there can be up weeks, down weeks, there can be a, you know, an inconsistent level of working. I think I've said on it, wouldn't the world be brilliant if everybody was just a 9-to-5 Monday to Friday worker? You know, these are gaps where we're just going to have to get clarity and guidance from government on it. But in terms of directly right now, declare, I can't give you an answer on it.
Yeah, interesting, isn't it? It's sounds like there's still quite a bit of work to be done, water to cross under the bridge before we're comfortable with this stuff. But anyway, listen to both of you. I'm conscious that it's 2 minutes to 4 and there are no more questions in the chat box there. So thank you very much. Claire Davey from KPMG. I know we didn't, so Dara was busy in the background, probably supplying Claire with some answers to questions and bits and pieces. And Tommy, thank you as always for your input. Claire and Dara from KPMG, who are available as partners of ours to answer questions to retail members in the background. So feel free to drop them a line. We'll put this into our member update, the slides from today into our member update tomorrow. And Claire, I think you referenced a report or something earlier in the year. Yes. If you can spin that over to yourselves, we'll stick that in the member update again as well for tomorrow. So thank you both very much. Thank you to everybody that attended the call, and talk to you all again very soon. Thanks a million, guys. Bye for now.
Thank you. Bye. Thanks, Duncan. Take care.